Hello. In the previous video, we have discussed the concept of net working capital. We have seen its main characteristics. This is a good transition, I guess, to recall the definition of net working capital that we saw in the previous video. So remember, another time again, net working capital is inventories, all type of inventories, raw materials, work in process, finished good, plus accounts receivables, minus accounts payable and the other accruals as we have defined them in the previous video. What is fascinating in the concept of net working capital is that it represents the meeting place of the various functions within the company. For example, the meeting place between the commercial function and the finance function. The commerce people, they want to sell as much as possible, and sometimes they give too much credit to the customers. And the finance people say, hey, wait a minute, your accounts receivables are going too high. See, all these functions may have different objectives and constraints, but at the end of the day, they have a crucial impact on the cash situation, on the liquidity of the firm. Another interesting observation on net working capital in many companies is that this is an investment like any investment, but there is a kind of fatalism applied to it compared to the strict discipline applied to the real investment, the net fixed asset investment, the capital expenditure. You very often see when people want to make an investment in a new machine, they have to do a lot of calculation, they have to show how good investment. At the same time, the net working capital is increasing tremendously and there is no study. I mean, it is a kind of fatalism. This is business. Next point is that very often you'll be hearing people telling you that net working capital is current assets minus current liabilities. It's a very common definition. This is incorrect, as it will overstate the net working capital of cash-rich company. Take the example of Microsoft or Apple. If you include cash if you take current assets minus current liability for Apple, you'll find that the net working capital of Apple is huge. Does it mean that Apple has a net working capital problem? No. No, it just means that Apple has $140 or $150 billion of cash. It will also, if you take current assets minus current liability, underestimate the net working capital of companies with a high level of short-term financial debt, such as bank overdraft, short-term bank loan. So, actually, net working capital is equal to the current asset excluding cash and cash equivalents, minus current liabilities, excluding all short-term financial debt. Now, which tools, which ratios are we going to use to analyze the net working capital? The first one, the global one, is very simple. Net working capital divided by sales, which measure how much net working capital the company needs for each dollar of sales. Let's assume you find for a company 0.33, or if you prefer, 33%. What does it mean? It means each time this company sells $100, it needs $33 of net working capital. This ratio, like any ratio, by the way, should be analyzed through time. What is important is the trend, and by comparison with similar companies in the same industries. It should also be decomposed into its main elements to discover where the problems or where the improvements can come from. Let's start this decomposition by looking at days of sales outstanding, DSO, or as we call it sometimes, the average collection period. DSO is how many days of sales have been built but not yet collected. And the formula is quite simple. It is the account receivables divided by the daily sales, average daily sales, or the account receivables multiplied by 365 divided by the annual sales. You remember the slides I used in the last video on different European companies with the Southern Europe countries, 70 days or more of collection, and the Northern countries with 30 days, big difference. The parallel of the days of sales outstanding for the customers is the days of payable outstanding for the suppliers, DPO, or as we call it sometimes, the average payment period. The calculation here depends if we get information on purchase or not. If you get information on purchases, the definition will be the accounts payable multiplied by 365 divided by the annual purchases. But if you don't get information on purchases, which is sometimes the case, you will do it with the cost of sales. And you will say that the DPO is the accounts payable multiplied by 365 divided by the cost of sales. Finally, let's consider the days of sales in inventory, DSI. DSI is how long the inventory are staying in the business before being sold. And the definition is inventories multiplied by 365 divided by cost of sales, because inventories are measured at cost. Three final comments and hints when you analyze the net working capital. We will never stress enough the fact that these net working capital ratios are really useful. We're using a time framework, the trend, and an industry landscape. Looking at the peers is, of course, important. Second comment, the homogeneity of data are crucial. In particular, if you want to calculate the CCC, the cash conversion cycle, which is equal to DSI plus DSO minus DPO. Days of sales in inventory plus day of sales outstanding in receivables minus days of payables outstanding. Finally, never underestimate the bias introduced in all this calculation by the seasonality. You remember the example of this company making its annual sales of 100 in 1 month in December with a 30-day credit to its customers that we used in the previous video? If you apply the DSO calculation at the end of December, what do you find? 100 multiplied by 365 divided by 100. 365 days. No, this is wrong. The DSO is 30 days. It's just because of the seasonality. You cannot say in December the DSO is 365 days and all the other months it is 0. So be careful about seasonality. In our next video, video 4, we will apply all the measurements presented in week 2 to the Gremlin company. So I'll see you pretty soon.